Hello, good morning. I'm Kim Abril, and I am the President and Portfolio Manager of Draco Global. And today I want to introduce you a new investment idea, in this case, a Spanish company, Inditex. In this video, I want to focus more this time in the numbers, so in how we make the valuation, and not in terms of quality, because I think this is a known company. All the people knows Inditex, all the people knows the competitive advantage. So I prefer to focus today in the numbers. Okay, first disclaimer. So in Draco Global, we are long Inditex. We can buy and sell shares. The price can go up or can go down. And we don't need, we are not subject to change without notice any report, video or something, or no commitment to update this report or any information contained therein. So before to start with the investment case, I want to remember you what type of stocks do we like to invest. So our portfolio is two portfolios inside of one, right? We try to invest in the best of two worlds. In one portfolio, mega caps, so big companies known for all, that we try to invest when they have a temporary problem, but this temporary problem is not invalidating their long-term competitive advantage. And the other part, so the opposite, to invest in micro caps and small caps, that they are really high quality companies, but they are known for the consensus because they don't have any analyst coverage, right? And this is the only reason, because these companies trade cheap. And then we implement a tail risk strategy with index options when we think that the economy is going to be in a deceleration or in a recession in the next quarters, okay? This strategy helps the fund to protect the micro cap and small cap portfolio of companies. In average, we like to have at least 50% of stocks in the small cap and micro cap segment. Okay, let me spend 1 minute with an executive summary, and then we start with the video. So if you look at the performance of the stock of Inditex, what you can see is that from the highs of 2018, the stock goes down 40%. And this, the consequence of that is the slowdown in Europe. The economy start to goes down at the middle in the summer of 2018, and then obviously this year at the highs of February with coronavirus. No, all the people knows which competitive advantage has Inditex, like in terms of design, innovation, working capital management, inventory, all these things. So I don't want to go much in deep in that time. The guidance of the company guidance is to grow like for like of 4% to 6% in annual terms, then to add new space, new stores, about 2.5% annual, and then they expect that online business could be grow to more than 25% of sales in 2022. So with all that information, we reach two scenarios. In the conservative one, we reach 26.4 euros per share. So we can have 25% upside from last Friday price. And in the bullet scenario, we can reach 34 euros with a big upside, more than 50%. So this is the brief. So let me start with the idea. Here in this chart, where you can see is where we talk, right? So the stock of Inditex make highs in the summer of 18 and then start to decelerate. They go down, the drawdown was 40%. Minus 40%, and then in the maximums of this year, when COVID starts, the stock goes down 30%. Okay, it is important, but we have to know why. What is the reason? Because the stock goes down 40%. Okay, I have three main reasons. Here you have two, but there are another one. Okay, the first one is economy, right? So we should to use in Draco Global OECD leading indicators, and here it's the leading for European. These indicators try to say what is happening in the economy in the next 6 to 9 months. Where you can see here is that at the middle of 18, European economy, the right line, start to accelerate. Okay. This is important because this is a cyclical business. So if you don't have money, or you are in a deceleration or a recession, you prefer to save money than to go to a store to buy things and accessories, right? So first reason is the slowdown of European economy that starts in the summer of 18. The second reason is that the business model of Inditex is changing a little bit because for the future, you can see here, this is the number of stores of Inditex. In average, is across 7,000. So in the past, Inditex has a high like-for-like, but right now Inditex is trying to not to open too much stores. They prefer to have flagship stores, so bigger stores where they can make more revenue for store. This is the idea, right? And then, as a consequence of the COVID, more than 50% of total stores, more than 50% of these 7,000 stores were closed during the COVID. You can see here in the month of March and April, there are only across 1,000 stores open. So this is a big drawdown, and this is the main reason for the drawdown of the P&L of the company for the first half of 2021, right? So then you can see in the second quarter that the number of stores open that start to recover. Okay, these are the main reasons, right? So slowdown in Europe, stores close, and also like for like is going to be down because also new space is down. Then when we look the Danish performance for the first half, where we can see is that in the first half, sales go down 37%. Okay, you can see here in this table. It's minus 44% in the first quarter and minus 31 in the second. But what is really a good management from the direction is that gross margins are stable across 55%, right? So this is the consequence of the unique model and logistic model of Inditex, that they can react and they can try to adjust cost and also working capital. No? Then with this slowdown in total sales, operating margins goes down to 18.5% versus close to 27% in terms of EBITDA. Okay, but if you look at the total OPEX, okay, these tables are in Spanish, but I think it's easy to understand in English. So when you look at total OPEX for the first half, look at that number. So it's 21% lower than the same number from the last year. This is unique, right? It's not easy for a company to decrease OPEX from to 20%. And the reason is this unique model, the integration with physical store, with online store. So, and I want to talk about that maybe later in the video, but that's really good. So we expect that in the second half, the company cannot continue with this same level of reduction of OPEX, but we can reduce someone, right? The third point, and the most important, is that online sale goes up 74% in the first half. This is amazing, and the company has a guidance, remember, that they want to grow online segment as percentage of total revenue to be higher than 25% for 2022. So, in conclusion, stable margins and reduction in operating expense, but sales go down 37% to 40%, right? Then, if we take a look at the working capital, what we can see is that the company has reached a reduction in all the lines that affect working capital, like inventory, existencias is inventory, deudores is accounts receivable, and acreedores is like supplier. So the company is trying to make a better improvement of working capital, and you can see here. So working capital as percentage of total sales in the case of Inditex is in a range of 6 to 8% of total revenue. But in this case, the company can reduce fondo de maniobra. Fondo de maniobra is working capital in Spanish. So the company is continuing to reduce that number. And one of the main reasons is because the days of inventory at the end of 19 was at 85 days. And first half 2020, it's 75 days. We think that number could go down to 70 days, and we try to estimate that number in our model or in our projections for the future, right? So this working capital, the performance of working capital for Inditex is unique, and it's totally different than other companies. So I don't want to go to be matching deep with competitive advantage, but we should think in terms of design. So Inditex has a good brand at a low prices. They react fast to new fashions and new trends. And right now there are the flagships. So the main shops are in the prime area location in the most important cities around the world. This is a change from the history of Inditex, and this is the reason because new space is slower than that was in the past. So the guidance is to grow 2.5%, and in the past the new space reached highs of 10%, I think. Second one is to make some cost advantage, like because this is a proximity level with a centralized inventory. Inditex manufacture approx 65% of total products in Spain or countries close to Spain like country. Inditex, the request time to the shop is 1-2 days, and Inditex, the management and the managers make shop replenish 2 times a week. This is really unique because the competitors make a frequency of 4 times a year, like quarterly. Inditex is not making any expense in advertising. They have working capital, negative working capital, 6 to 8% of total revenue, and the scale is bigger than competitors. What is the output of that? So Inditex has a better gross margin in a range of 56 to 60%. Competitors in average are at 46. In terms of operating margin, the gap is much bigger. Okay, Inditex is 17% and competitors is 3 to 5%. The reason of this one is like this. Okay, return on invest capital, is it across 20%, and is it sustainable across the business cycle? So it's not cyclical. Competitors are much lower than the cost of the capital, 3 to 5%. And the most important, like the performance of working capital. Inditex has a cash conversion cycle that is negative, but the competitors has to finance 100 days. This is a really huge difference, and I think that difference could maintain for the future, right? Also, inventory turnover in Inditex is 10 times, and the best player of his competitors could be at 5. So this is the main competitive advantage for Inditex. What is the outlook for 2020? The management in the last half presentations, they talked that the fall-winter collections, they are responded very well, that 98% of the stores are open. I'm really concerned about here because this is before the second wave. So I want to expect to the report of the third quarter. I think it's at the beginning of December, because I think there are maybe some percentage of the total stores that could remain closed. I don't know if all week, but maybe in the weekend. But okay, that number could be a little bit lower than 88, maybe 90%, right? And the company advanced that the sale in store and online lowers at minus 8% from August 1 to September 6, right? This is the outlook for this year. Then when I'm investing in mega cap companies, I like to look at the consensus estimates, because it's interesting to know before investing in Inditex or any mega cap, to know what the consensus is thinking, okay? Here, what consensus is telling us is that consensus expect that for the third quarter, sales go down minus 14%, and for the fourth quarter, 12% down. And then consensus expect recovery in next year, right? Remember that fiscal year for Inditex is January next year. So in this year is January 2021, okay? But we're in 2020. This is the reason because I'm talking about 2021. So consensus is expecting these numbers for total revenue, okay, that they are revised down, you can see here. The gray area it means that the analyzed revision, for the last 3 months, where you can see is that analysts with the COVID crisis, they they change estimates to a minus 25% down, and then they are more positive and they recover until 5%, right? So right now consensus is a decrease of 5%. In terms of EBIT, consensus for this year is 2,000. For next year is a little bit higher than 4,000. And then in terms of margins, the consensus was lower than 10% in terms of EBIT margins for 2021, and is it close to 16.5 for 2022. In terms of EPS, it's 0.49 for 2021, and for 2022 it's across to 1.04. So here you can see how the consensus is make the estimates, and you should to think about that and make your own decisions, right? What is the guidance of the company, the midterm guidance? The midterm guidance is to grow with the like comparable sales growth. So that number, try to compare with the same number of stores from, not from the year, because the like for Inditex is for 2 years, because they think that only in the second year, the company reached a conversion revenue of 90%. Most of his competitors use 1 year, but in the case of Inditex, they use 2 years. But in any case, comparable sales growth is to compare revenue growth with the same number of stores, right? So the company expects to grow 4-6% annually, and then in new space, the company expects to grow 2.5% annually, right? This is more or less 150 new stores a year. The reason for this number is because in the past, this number which was higher, like 5%, 10%, 12%. The reason is that Inditex isn't concentrated more into try to absorb shops and to try to change and transform some shops, because they prefer flagships with more space and where they can reach more revenue per store, right? So this is the reason, because new space is lower than in the past. Then the company expects to invest 900 million. This is the capex number a year. And also they want to continue to integrate physical and online stores, so to improve the performance of working capital. And they have some goal for online sales. The forecast is to be higher than 25% of total revenue for 2022. And they want to invest at least 1 billion in the online channel. We are more positive than for this number than the company, and we reach 30% for 2022, okay? So it's important to know what is the guidance of the company, because this guidance helps us with our projections and with our estimates, right? What are the opportunities here in Inditex? First one is growth online segment, okay? The second one is that I think Inditex could increase market share, because there are some small players that they should to exit the market as a consequence of COVID, because the probability is so low, maybe they have some debt, so they have to exit to disappear the market. So this is a way for Inditex to win market share. And then remember that the world market share for Inditex is only 1.5%. And if we talk in terms of online revenue, because this 1.5 is for physical stores, in terms of online revenue, the market share is only 1%. We think that in the next 5 to 10 years, Inditex could reach 3% for physical stores, and in online stores could double to 2, 3, 4, or 5%, because we are very, very positive with online stores. So you should to remember this number, because this is really, really, really important. Okay, go to valuation. So we try to model 2 scenarios, the conservative one and the bull case with more positive and more. We try to use the guidance of the company to try to construct this bull case of 34 euros per share, okay? Here, what you can see is our projection of revenues for the conservative scenario. In Draco Global, we like to go deep with the revenue number. So we don't like to apply percentage of growth to the revenue numbers that consensus have. We like to make a break-even and to try to understand where are the drivers of the revenue of the company. For example, in the case of Inditex, the drivers of the revenue was 2 segments, retail business and online business. And then inside of the retail business, we have 3 variables. The first one is like for like. The second is new space growth, new stores. And the second one is currency, right? So we have to understand how all these 3 variables are performing in the past to try to model it to the future. For example, in terms of like for like, we're expecting a decrease of 35% for 2021 for this year. Remember that at the first half, this number is more or less 40%. Okay, we have some recovery in the third quarter, but we are not sure about the fourth quarter because the second wave and the new lockdowns can decelerate that number. So we prefer to be conservative, and we are using minus 35%. Then we expect some recovery for 2022, not a big recovery because this is the conservative scenario, but we expect some recovery because in the next year we have the vaccine, so we expect that at the end of March, April, pharmaceutical companies and governments can start to distribute the vaccine. So we have some recovery. And then for the next 3 years until 2025, we expect a conservative like for like of 1% annual growth. This is really conservative, right? Because remember that Inditex is changing the business model, and they prefer to invest more in flagship stores that they have a better and higher revenue per store, and they want to close and absorb some stores. But I think this is the conservative, so I prefer to use 1%. Then in terms of new space, we are using 2% because Inditex has new markets that they can reach and they can open new stores. So I can think it's reasonable to think about a 2% expansion growth. And in terms of currencies, I prefer not making any estimates because any knows what is the dollar at the end of next year. So in total revenue in the physical store growth was minus 34 for 2021, this year 17, and then to grow at a low number like 3%. So the total compound annual growth rate for retail business was 5%. That I'm really comfortable with that number. Then the interesting is the online business. For the last 2 years, 2019 and 2020, the online sales, was growing in average at 25%. Then with the COVID and the quarantines, people cannot go up, commercial shops are closed, so all the people start to buy online, right? This is not only for Inditex, so I can check with other retail business. For example, in Draco Global, in our portfolio of shares, we have one stock, the name is Adairs, who is a retail business in Australia. It's like a Zara Home in Australia. That business, before the COVID, they was projecting that online revenue could be 12% of the sales, and right now is close to 30%, and they expect to reach 40 or 50% of total revenue in 2 years. So all retail business that they have a good omni-channel in online sales, they can grow very, very fast. No? So we think that this year the growth in online is really high, and we expect that in the next year, especially the 2022, that growth could reach also 25% because the online business is not open in all the markets, and the company has the target that to open all markets also in this year. So to reach in 2020, to reach all markets that they have online business. But we know that there are some countries in Latin America, like Peru or Uruguay, that the company is in the way of to open, but right now I think it's not open. So at the end, the compound annual growth rate for online business, we estimate like in average 15.5%, that I think it's quite fair. Then in terms of total revenue, the compound annual growth rate for total revenue, it's across 8.5, that I think it's really good for a conservative scenario. Then in terms of P&L, we incorporate our revenue metrics here. Okay, you can see is the slide that we talked before. And then in terms of gross margins, we expect 55%, which is the same than the first half of this year. And then we are make some improvement until 57. Sorry, for the next 5 years until to reach 57 in the 2025. Remember that the average gross profit for Inditex range from 56 to 60%. So there are some potential to increase gross margins because first, online business has a better gross margin and a better operating margin than the retail business. Second, the company is trying to decreasing structure, while structure is here in operating margin, but the company is is implementing innovations in terms of working capital. So I think the cost of revenue could be a little bit down. So we are performing 0.5% gross margin improvement for year, like you can see here, okay, and here. And this is the reason of the unique working capital performance and the integration of physical store and online store. And then in terms of operating margin, yes, like this is EBIT margin. We are a little bit bigger than consensus because consensus for this year is below 10%. We are higher than consensus because we think that the company can continue in the second half with the improvement in terms of operations efficiency and turnover, right? So we are estimating that number for 2020, and then we are increasing this number until 20%, like, and to reach in 2025 a EBIT of 20%, because we expect some better improvements in terms of SGA. Okay, we are using, I don't remember right now the number, but I think we are decreasing from 20s to 70% as percentage of total revenue, this number. Okay, so at the end, we reach for the next 3 years. This is our target in terms of time, is to look 3 years from now. So we are looking at 2023. So we expect an EPS of 1.25. Is it bigger than consensus estimate, right? In terms of balance sheet, this is a really easy balance sheet. So if you look current assets, you can see cash and the negative working capital that the company invests in short-term investments. So current assets is cash and then working capital. So if you add receivables and inventory, that number is it lower than accounts payable. This is the reason, because the company has a negative working capital. And this is, sorry. And this is the main difference of the company when you compare with the competitors. Then you have net property. You have also an undervalued real estate here in long-term investments, and here also. You can reevaluate some real estate because I think most of that investments were at cost. So this is a source of hidden assets. Okay, and then the company. Some investors, some analysts say that Inditex is a net cash company. This is not true, because with the change of IAS 16, this is accounting rule. Okay, look that at the end of 19, the company report that total debt was 90 million, right? Here you can see total debt. Also you have working capital revolvers, but total debt is 90 million. Then total debt goes up to in approximate 7,000 million. Why? This increase in this number is consequence of the change in the accounting rule IAS 16. So all operating leases with maturity higher than 12 months, they have to capitalize in the balance sheet. You should to create an asset, an intangible asset, and you should to create debt. So for us, this is new debt. This is not a problem for Inditex because the cash and the short-term investments are higher than this debt, so that's not a problem. Okay, but Inditex is not a net cash business. No? And then in liabilities, common stock equity is more than 50% of total liability. So no problem in terms of balance sheet. In terms of statement of cash flow, so we take our estimate for net income, that we add depreciation, amortization, then we make some change in net operating assets. We reach our cash flows from operation, and then we should to subtract capital expenditure. So remember that the guidance was 900 million a year. So inside of the number, we have the CapEx, but remember that Inditex have two ways of growth. The first one is to buy buildings, to buy shops, and the second one is to lease these shops. Remember that with the new accounting rule, right now, when you look the financial of Inditex, you are not looking for operating leases, you are looking for capital leases. So this is when you capitalize in the balance sheet your lease. So where you should do add is the new lease, the new capital lease that this new accounting rule has created. These new leases is CapEx, because this is money that the company invests in new openings, right? So, and this is not here, sorry, that is included in this number. So 200,600 is annual capex plus new capital leases. Okay, this number is just because the working capital model of the company is negative. The company have to invest the money in marketable securities. So here you can see the improve in working capital. Okay, so this is just to invest in short-term investments. This number 3,300. Okay, so this how it works, the P&L, the balance sheet, and the statement of cash flow for Inditex. So at the end, our adjusted free cash flow number for 2023, it's 4,163. This is in the conservative scenario. Okay, and with that number, we try to model our target price for the conservative. Here at the top, you have a chart. This chart is related to the PE of the historical PE of the company. What we can see is that the average is across 23 times, but in 2015, 16, 17, the market is going to pay 30 times for Inditex. I think today the market is assigning a lower multiple than the historical one due to a lower growth, because the new space, the expected new space growth, the expected like-for-like could be lower than in the past. So it's not making reason to use 30 times or 25 times in terms of valuation. In that case, we take the free cash flow metric, then we multiply for 21 PE, that we think is more reasonable than 25 or 13 times. And then we subtract the net cash, right? We reach a target price of 26.4, which is a upside potential of 25%. I think that the reference for stock price is last Friday. I think it's close to 21.5 or something like that. So this conservative scenario, right? And then we have a second scenario, who is the bull scenario, where we reach 34 euros for share. And the main difference is our estimate for like-for-like. In the bull case, like-for-like is going to be 4% in terms of annual. Remember that the guidance of the company was to grow in a range of 4 to 6%. So we are in the lower range of the company. So this target price could be higher, could be 37, 38 if we use 6% in our estimate. And then we use the same number that the company guidance for annual new space growth, so plus 2.5%. If you look here, but this is the same metric, but it's not in the last chart. This is next 12-month PE, so from the last 15 years. So the PE that the analysts are estimating. In that case, is historical PE. This is not estimates. So here the average PE is 27. It's higher, okay. And remember that these years 15, 16, 17, so that number could be higher than 30. So for this bull scenario, we use the free cash flow of 4,441 million, that the main difference with the conservative is this one is to use a 4% annual growth in terms of like-for-like. And then we are using a 25 times P, and then we subtract cash. So we reach 34 euros with an upside potential of plus 60%. So we think right now Inditex is a really interesting opportunity for any investor, because in the conservative scenario, you are not losing your money, because I think it's really difficult that the company cannot perform the numbers. And then I think you can expect to reach the bullish scenario, because Inditex has all the aspects and all the quality to try to reach these metrics for the future. So you can reach 60%. So if you like these videos, if you want to spend time to try to record more videos, please subscribe to my channel. And if you have any question, you can go to my webpage and you can send me emails and things. And here you have a picture of the different videos that I like to upload to our channel. This is our channel. So videos related to investment thesis, videos related to accounting red flags, videos related to update about our portfolio. I try to update 2 times a year. So, well, if you like these videos, please subscribe to the channel. And well, that's for all. I see you in the next video.